Looking for a market-smashing yield near 5%? Want to own a high-quality dividend aristocrat? Interested in buying a stock after it's corrected? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing the world with therapeutics. Demand for quality healthcare isn't going anywhere but up over the long run. Demographics will tell you this. The world is growing larger and older, plus average wealth is on the rise. That's a greater pool of older people with more money in their pocket who will no doubt need and want quality medicine. And that should translate to higher profits for this company. That means more dividends and more money in our pockets. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of AbbVie Inc., which appear to be trading at a significant discount today. AbbVie Inc., stock ticker ABBV, is a global pharmaceutical company with a particular focus on immunology and oncology. With a corporate history that can be traced back to 1888, AbbVie is now a $190 billion by market cap pharmaceutical behemoth that employs 48,000 people. AbbVie sells its products in more than 175 countries. Humira, an immunosuppressive medication, is by far their largest and most important product, accounting for approximately 43% of fiscal year 2020 revenue. This drug had net revenue all by itself of nearly $20 billion last fiscal year. Humira has been both a blessing and a curse for AbbVie, much more of the former than the latter to date, but that could be changing soon. On one hand, it's been a total blockbuster. It's the best-selling drug in the world. On the other hand, it represents an outsized percentage of total company revenue. Biosimilar competition now threatens to severely harm the company's future earnings. The dreaded patent cliff is coming, with Humira's patent protection expired in Europe already and expiring in 2023 in the United States. Understanding this, AbbVie has gone out of their way to be proactive. They've attempted to protect the business through licensing deals, additional patents, R&D spending, and a massive acquisition. Regarding that last point, in 2020, AbbVie completed its $63 billion acquisition of Allergan plc. This was a transformative acquisition which instantly and significantly expanded and diversified the combined product portfolio. AbbVie stock has recently corrected. The FDA announced on September 1st that AbbVie's drug Rinvoq would require a new and updated warning label. The stock is now down more than 10% from its late August high, and this pullback is partly why I'm featuring the stock today. Investing in a major pharmaceutical company is largely a bet on favorable demographic trends. You're betting on the continuation of what's already been playing out for many years. The world is growing larger, older, and richer. A larger pool of older people who have more capital is almost a straight line to greater demand for and access to top-notch therapeutics. This bodes well for AbbVie's ability to grow its profit and dividend for the foreseeable future and beyond. As it stands, AbbVie has increased its dividend for 9 consecutive years. However, that short track record belies the company's true dividend growth heritage. AbbVie is actually a dividend aristocrat. That's because of the multi-decade dividend growth track record that was built up when they were part of legacy company Abbott Laboratories, stock ticker ABT. Abbott Laboratories spun off AbbVie in 2013. That explains this newer, shorter track record, but make no mistake about it, AbbVie's dividend growth pedigree is of the highest quality. The 5-year dividend growth rate of 18.5% is rather incredible incredible, especially when you think about how this is a dividend that's really been growing for decades. However, the most recent dividend increase was a more down-to-earth 10.2%, but this is still more than enough dividend growth when you consider the stock yield's 4.9%. That's more than 3 times higher than the broader market's yield. It's also 100 basis points higher than the stock's own 5-year average yield. This is an extremely compelling combination of yield and dividend growth here. And with the payout ratio at 41.4% based on midpoint guidance for this year's adjusted earnings per share, investors should be able to count on plenty more healthy dividend increases to come. These dividend metrics are nothing short of highly impressive. Looking at business growth, AbbVie has increased its revenue from $18.790 billion in fiscal year 2013 to $45.804 billion in fiscal year 2020. That's a compound annual growth rate of 13.57%. I usually look at 10-year periods for business growth, but AbbVie went independent in 2013, and that's why 2013 is the starting point in this case. Meanwhile, earnings per share advanced from $2.56 to $10.56 over this time frame, which is a compound annual growth rate of 22.44%. Now, I did use adjusted earnings per share for fiscal year 2020. That's because the company routinely takes charges and reports lumpy and arguably inaccurate GAAP earnings per share. I see the adjusted number as more indicative of their true earnings power. These are gaudy numbers, which isn't a total surprise when you have the world's best-selling drug in your portfolio. As I foreshadowed, however, investors are going to have to brace themselves for a serious cooling off. I don't think it's reasonable to expect AbbVie to continue posting numbers like these. Looking forward, CFRA believes that AbbVie will compound its earnings per share at an annual rate of 4% over the next 3 years. Humira is largely responsible for this forecast. CFRA states this, and I quote, AbbVie's revenues have historically been largely tied to sales of its Humira, 57.6% of pre-merger adjusted net revenues, which began to experience biosimilar competition outside of the US, OUS, in October 2018. In 2020, US Humira sales grew 8.4% year over year, while OUS sales of Humira declined 13.6%. In 2021, we expect US sales to grow 8% and OUS sales to decline 17%. And that's the story here. AbbVie still lives and dies by the Humira sword. That said, the Allergan acquisition does help to soften the blow, particularly when looking out over the longer term. The pipeline, which has grown, is strong. AbbVie had more than 90 compounds or indications in clinical development as of the end of 2020. But since Humira is such an outsized effect on the company, the drop in growth over the next few years will almost certainly still be very noticeable. Speaking on this, CFRA states the following, and I quote again, although the acquisition provides revenue diversification, robust long-term free cash flows, and organizational synergies, we don't think Allergan's assets do much to help offset the upcoming loss of exclusivity for AbbVie's blockbuster drug, Humira, unquote. I don't see all this as doom and gloom though. It's simply a case where growth expectations are going to have to shift. Mid-single digit business growth, which should translate to similar dividend growth, is nothing to shake your head at. After all, the stock yields nearly 5%. Also, it's not like Humira is completely disappearing. It will still likely sell well. It's just not as well as it used to due to the increased competition. To add perspective, AbbVie is guiding for $12.57 in adjusted earnings per share at the midpoint for this fiscal year. That would represent 19% year-over-year growth in adjusted earnings per share. So the slowdown in growth might not be all that sharp. Moving over to the balance sheet, this is probably the weakest part of the business. AbbVie is heavily indebted. The Allergan acquisition exacerbated this situation. The long-term debt-to-equity ratio is 5.9, while the interest coverage ratio is over 2. Low common equity pushes up the debt-to-equity ratio, but the interest coverage ratio is precariously low in my view. Credit ratings are as follows: Moody's, Baa2, Standard & Poor's, BBB+. AbbVie will need to improve the balance sheet, which will divert future cash flow away from dividend increases. Combined with the slowing growth of the underlying business, double-digit dividend increases are unlikely to persist. Profitability is very robust. Selling the top drug in the world will do that. Over the last 5 years, the firm has averaged annual net margin of 18.9%. An average of return on equity is not applicable because common equity is frequently negative in this case. Despite some chinks in the armor, I still see AbbVie as a high-quality, desirable business, and they're protected by durable competitive advantages that include economies of scale, a global distribution network, patent protection, IP, and R&D. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Competition will soon become even more vicious when Humira comes off patent in the US in 2023. Patent cliffs are always a risk with pharmaceutical companies. The risk here is severely heightened with AbbVie due to the drug in question and the near-term time frame. Growth over the next few years will almost surely be much less impressive than growth over the last few years. Any broad changes to the US healthcare system would likely affect AbbVie. All pharmaceutical companies have pipeline risk. The pipeline is pressured to produce successful drugs in order to support sales, rationalize R&D, and mitigate patent cliffs. While AbbVie has one of the biggest pipelines out there, compounds that fail to go to market can be major setbacks. The balance sheet is heavily indebted, creating liquidity risk and limiting future acquisition opportunities. Lastly, there's integration risk with the massive Allergan acquisition. There are certainly some risks here, but I also see a lot of quality and value to be had. Regarding the value, this stock's recent correction has made it rather attractive. The stock is trading hands for a forward price earnings ratio of 8.5. That's based on midpoint guidance for this fiscal year's adjusted earnings per share. While I think the market is right to assign a low earnings multiple here because of the near-term uncertainty around Humira, this seems a bit extreme. The price to cash flow ratio of 9.3 is well off of its own 5-year average of 12.2, and the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate due to the elevated yield and a long-term dividend growth rate of 5%. This dividend growth rate looks awfully conservative when you line it up against the demonstrated long-term double-digit dividend growth from the company. There's also the double-digit earnings per share growth to look at, and the payout ratio is not dangerously high. However, there's a lot of uncertainty regarding just how well this company will perform when Humira loses its patent protection, and the balance sheet needs attention and cash flow. I'm assuming long-term mid-single-digit dividend growth here, which is taking CFRA's near-term earnings per share growth forecast into account. It might prove too cautious, but I'd rather err on that side of caution. The dividend discount model analysis gives me a fair value of $136.50. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates AbbVie as a 3-star stock with a fair value estimate of $108. CFRA rates AbbVie as a 3-star hold with a 12-month target price of $125. I came out slightly high this time. Averaging the three numbers out gives us a final valuation of $123.17, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. AbbVie Inc. is a high-quality pharmaceutical company that owns the best-selling drug in the entire world, with a market-smashing yield near 5%, a moderate payout ratio, a dividend growth legacy that dates back decades, double-digit long-term dividend growth, and the potential that shares are 15% undervalued. This is a dividend aristocrat on sale for dividend growth investors. And now for a special news announcement. US Bancorp, stock ticker USB, just announced that they acquired MUFG Union Bank in an $8 billion cash and stock deal. This gives US Bancorp more customers, more deposits, and more scale. They also see the transaction as approximately 6% accretive to earnings per share in 2023. I highlighted US Bank in late August as a high-quality dividend growth stock that appeared to be undervalued. This bolt-on acquisition only gives me more confidence in their long-term prospects. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.